Good evening. Tonight, we turn our attention to Canada, where a quiet but dramatic financial standoff is unfolding. Ontario, Canada's economic engine, has just shut out American banks from a major bond sale, a move that's reverberating from Wall Street to Bay Street. This isn't just about numbers, it's a direct response to rising American protectionism and a warning shot in a new kind of economic conflict. For decades, the US-Canada relationship was built on trust and open markets. Now that foundation is cracking. Ontario's decision could set a precedent, impacting everything from Wall Street profits to jobs in Windsor. Tonight we'll break down how this happened, what it means, and where this escalating standoff could lead. Stay with us. To grasp Ontario's move, you need to understand the deep financial ties between the US and Canada. For generations, Canadian provinces relied on US banks to fund growth, with Wall Street giants like JP Morgan and Goldman Sachs leading the way. This wasn't just business, it was a symbol of trust and mutual prosperity. Ontario, one of the world's largest sub-sovereign borrowers, depended on US markets for efficient large-scale financing. But as political winds shifted, so did the relationship. Protectionist rhetoric replaced cooperation, and trust gave way to suspicion. What was once unthinkable, excluding US banks from a major deal, became reality. The old rules no longer apply. The deep integration that once united both economies is now seen as a vulnerability. This set the stage for Ontario's dramatic break. The spark for this financial standoff? President Trump's renewed tariffs in early 2025. Ontario, Canada's manufacturing heartland, was hit hard, especially in auto, steel, and aluminum. Unemployment spiked and economic anxiety soared. Premier Doug Ford's government responded with bold retaliation, restricting US firms from public contracts, pulling American products from shelves, and prioritizing Canadian materials. The message was clear. Ontario wouldn't be a passive victim. These moves were risky, but the cost of inaction seemed higher. The traditional tools of diplomacy had failed. Ontario was ready to fight fire with fire, using every economic lever at its disposal. The stage was set for a financial showdown. The bond deal was about to become the next battleground. In June 2025, Ontario stunned global financial markets with a bold move. A $2 billion 10-year bond sale that made headlines not just for its size, but for who was left out. For the first time in recent memory, every major American bank was excluded from the deal, sending shockwaves through the industry and raising eyebrows on both sides of the border. Instead, the deal was led by the UK's Barclays and Canadian banking giants BMO, CIBC, and Scotiabank. This wasn't a random choice or a simple reshuffling of partners. It was a calculated decision, carefully orchestrated to send a message about who Ontario trusts with its financial future. Just months earlier, US banks had been co-leads on similar deals, enjoying lucrative fees and a seat at the table. Now they found themselves completely shut out, left to watch from the sidelines as Ontario charted a new course. The bond sale itself was a success, but the real story was the message behind it. Ontario was willing to inflict real financial pain on Wall Street, showing that it could use its economic power as leverage in a time of rising tensions. Millions of dollars in fees that would have gone to US banks were now off the table, a tangible penalty that hit where it hurt most, the bottom line. The bond market, usually a place of quiet calculation and routine deals, suddenly became a stage for geopolitical signaling. Every move was scrutinized for its deeper meaning. This was economic statecraft in action, where financial decisions are wielded as tools of diplomacy and power. The timing was no coincidence. Ontario's move came just as new US tariffs were biting deeper into Canadian exports, escalating the economic standoff. By following through on its threats, Ontario proved it was serious and demonstrated that it could reshape its financial alliances if pushed too far. The deal will be remembered not for its yield or technical details, but for the powerful message it sent to markets and policymakers alike. In a single stroke, a trusted ally had weaponized access to capital, reminding everyone that in today's world, finance is as much about strategy as it is about numbers. Officially, Ontario claimed the exclusion of US banks was just a routine rotation. Finance Ministry spokespeople insisted it was business as usual, not retaliation. But no one in the financial world bought it. The timing, the context, everything pointed to a calculated political move. Market analysts saw it as a clear message to Washington, delivered with plausible deniability. This is classic economic statecraft. Send a signal, avoid a direct diplomatic clash. Other provinces like Alberta had already taken similar steps, and US bank executives admitted the tariffs were costing them business. The pattern was clear. The real story was written in the market's reaction, not the press releases. Wall Street felt the sting first. Millions in lost fees and a worrying precedent. The financial world is built on trust and predictability, and when those are shaken, the ripple effects can be swift and far-reaching. Investors and analysts watched nervously as the news broke, wondering if this was just the beginning of a much larger shift in cross-border finance. If Ontario's move spreads, US banks could lose significant business in Canada. These institutions have long relied on Canadian markets for steady profits and growth, and a sudden change in policy could force them to rethink their strategies. The uncertainty is unsettling for both American and Canadian financial professionals who depend on stable relationships to drive economic success. Canadian banks gained in the short term, but risk retaliation in the US, where they have major interests. Many Canadian financial institutions operate extensively south of the border, and any escalation could jeopardize their access to lucrative American markets. The interconnectedness of the two economies means that gains on one side could quickly be offset by losses on the other. For Ontario businesses and workers, the stakes are high. Local companies rely on affordable financing to expand, hire, and innovate. Workers depend on a healthy business environment for job security and growth opportunities. Any disruption in the financial sector could have real consequences for families and communities across the province. Retaliation may protect some jobs, but could also raise borrowing costs, threatening public services and investment. Higher interest rates could stall infrastructure projects, delay business expansions, and put pressure on government budgets. The effects would be felt not just in boardrooms, but in schools, hospitals, and neighborhoods throughout Ontario. The risk of escalation looms. A tit-for-tat spiral could disrupt trade, raise costs, and hurt both economies. With so much commerce flowing across the border every day, even small barriers can have outsized impacts. Volatility in financial markets could spill over into the real economy, affecting everything from exports to consumer confidence. If the US retaliates by restricting Canadian access to its capital markets, the fallout could be severe. Canadian companies might find it harder to raise money, invest, or even operate in the US. The consequences could ripple through industries, affecting jobs and growth on both sides of the border. The bond deal was a bold statement, but it's pushed both countries into uncharted territory. Policymakers now face tough choices, balancing national interests with the need for cooperation. The world is watching to see how leaders respond to this unprecedented challenge. The ultimate cost will depend on what happens next. Decisions made in the coming weeks could shape the economic landscape for years to come, influencing everything from investment flows to job creation. Cooler heads must prevail to avoid lasting damage. Only through careful negotiation and mutual understanding can both countries protect their economies and ensure a stable future for businesses and workers alike. Ontario's move split Canada. Alberta, also hit by US tariffs, joined Ontario in excluding American banks from its own bond deals. This signaled a coordinated front from Canada's two largest provincial economies. But British Columbia took a different path, including US banks in its bond sales to keep borrowing costs low. BC's finance ministry prioritized access to global investors over political statements. This division reveals a national dilemma: confront US protectionism together or protect local interests individually. The lack of unity could weaken Canada's bargaining power. Provinces are weighing risk versus reward in real time. The country is not of one mind. Canada's response is as fractured as its geography. Experts warn that this tit-for-tat escalation is a dangerous game. The bond market thrives on stability, not politics. Excluding US banks could raise Ontario's borrowing costs, diverting money from public services. The risk of US retaliation is real. Washington could make it harder for Canadian entities to access US capital. This could chill investment and damage both economies. The fear is a downward spiral, escalating penalties, disrupted capital flows, and mutual harm. Ontario's frustration is understandable, but weaponizing finance sets a risky precedent. Political risk now clouds what should be a financial decision. International investors may grow wary of Canadian debt. The strategic victory could be overshadowed by long-term costs. Ontario's exclusion of US banks marks a dramatic turning point in North American finance, sending shockwaves through both countries' economies. This bold move signals a new era, where old assumptions about cross-border cooperation are being challenged in real time. What began as a seemingly routine trade dispute has now spilled into the very heart of the financial system, affecting not just corporations and governments, but everyday people on both sides of the border. The stakes have never been higher. US banks are now facing significant revenue losses and a troubling precedent that could echo across other sectors. Meanwhile, Canadian banks may see short-term gains, but they also risk a backlash from international partners and investors wary of instability. For Ontarians, this is a high-stakes gamble, one that aims to defend local jobs and industries, but could also lead to higher prices, reduced choices, and a climate of economic uncertainty for families and businesses alike. Across Canada, provinces are divided. Some advocate for confrontation, believing it's time to stand up to US pressure, while others urge pragmatism and caution, worried about the broader consequences for national unity and prosperity. The old assumption that economic integration guarantees peace and stability is now being put to the test, as trust between neighbors begins to erode. Today, the very tools of capitalism, trade, finance, and investment are being wielded as weapons in a new kind of conflict, one that could reshape the continent's economic landscape. Experts warn that if this spiral continues, both economies could suffer lasting damage, with ripple effects felt by workers, consumers, and investors far beyond North America. The future is more uncertain than ever. Will this prove to be a temporary skirmish, quickly resolved, or the beginning of a deeper, more lasting rift between two longtime allies? What happens next will define the US-Canada relationship for years to come, shaping the lives of millions and setting the tone for international cooperation or conflict. We want to hear your thoughts. Share your perspective in the comments below, and don't forget to subscribe for more in-depth analysis. Good night.